Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is September 15th, 2026. We're here with world-renowned economics professor Edwin T. Burton. Professor, today the S&P closes above 6,600 for the first time. U.S. 10-year Treasury yield 4.039. The U.S. 2-month Treasury 4.087. The Federal Reserve meets tomorrow, decides on Wednesday whether they'll change the federal funds target rate. Will they reduce 25 basis points or 50 basis points?
25. There would always be the possibility they could go 50, but that would depend on using their balance sheet. And they've been on the policy up until fairly recently of reducing the balance sheet, and they've not continued to reduce it. Secretary of Treasury Buffett criticized them for that a few days ago. But the only way they could do 50 is if they plan to use the balance sheet in a big way, and that would mean more inflation. So they will do 25. But if they were ready to use the balance sheet, rates are close enough to 40 now. If you look at the 1-month Treasury is about 412 or somewhere in there. And the 2-month is, as you said, 408. That would put them right at the 4 to 4.25 target for the federal funds rate. And that's what they'll do on Wednesday.
The current federal funds target rate is 4.25 to 4.50?
That's correct.
And does the fact that the yield on the U.S. 1-month Treasury is 4.14, does that provide a disincentive for lowering to 50 basis points as opposed to 25 basis points?
That would set up a clean arbitrage with the 1-month bill sitting there. You could buy that bill, for example, and finance it at 4 if they did 50. And the only way that wouldn't work is if for some reason or other they decided to turn around and change policy between now and 30 days, which they're not going to do. So the only way they can avoid all that is to use their balance sheet in a very big way, and they don't know how big they'd have to be. It's like asking the question, if the Federal Reserve wanted the price of General Motors to double, they could do that. They do have the power to coin and print currency, so they could just buy enough of General Motors to do that. But they don't know whether it would take 100,000 shares or 100 billion shares, or, well, it wouldn't take that many. So they don't know that, and they're not going to experiment with it, so they'll do 25 basis points on Wednesday.
Treasury Secretary Scott Bessent has stated that the U.S. government should reduce the money supply in an effort to reduce rates. That sounds counterintuitive. Does that make sense?
If you reduce the money supply, the only way to really do that is to sell some of the Fed inventory, and the bulk of the Fed inventory is U.S. Treasuries. So if they did that, if they sold, for example, Treasury bills, that would raise rates. And that's one reason the Fed quit reducing its balance sheet, is they were concerned that reducing the balance sheet had the net effect of raising rates, and they wanted to go the other way. So they stopped reducing their balance sheet a few months ago. And Bessent criticized them for that, strangely enough. But the reason they did it was, so if you reduce the money supply, essentially by selling Treasury bills into the market, that's how you do it. You bring cash back in and you sell something to the public, and cash comes back into the Fed and is taken out of the money supply. So that's how they reduce the balance sheet. That's going to put upward pressure on rate, not what Bessent is hoping for. So it's kind of an inconsistent view for the Treasury Secretary. Said that he wants lower rates, but he wants policies that would essentially work in the other direction.
Professor, many small businesses are wondering, are we heading towards a recession, or will things improve? Will GDP grow? What has been the GDP for the first 6 months of 2025, and where do you see us going in the next quarter, next half year?
The first half of the year came in at about 1.3% on an annual basis. The first quarter was negative, the second quarter was positive. And if you put the two together, you're looking at about 1.3% on an annual basis. That's within a margin of error of the estimate. So that might be no growth at all, or it might be a little bit stronger growth, but it's below trend. There's no question. This economy has grown historically between 2.5% and 3% most of its years. It used to grow at a faster rate than that, by the way. But in the last 3 decades, it's slowed quite a bit. Some argue that's the natural maturing of an advanced economy. I don't think so. I think that's the maturing of a bigger regulatory regime, because it's just much harder to deal with all the regulatory burden that banks have, which was accelerated after 2008. All of a sudden, with the advent of the new regulation that was imposed in 2009, the banks have a much tougher time making loans. Businesses have a tougher time doing business, so that slowed the economy inevitably. Probably partially caused the lower rates that we saw, because the investment demand fell off during that period as well. So we're growing very slowly, if at all. And I foresee, and I've said this in previous podcasts, I see a weakening of the economy. I've seen it really since the first quarter. And you can see it in the consumption growth numbers. If you look at consumption growth over the last 3 quarters, it's steadily declined. And there are only 2 big, other than the government, there are only 2 big things in gross domestic product: consumption and investment spending. And if you see consumption spending trending down, which you do see and have seen for roughly 9 months, now the question is, will investment spending hold up? And a lot of investment spending is tied into areas that are highly speculative in nature. Crypto, for example. Another example is the artificial intelligence boom. A lot of the investments there, and there are growing indications that AI is having trouble figuring out its purpose in life. Whenever somebody finds a serious use for AI, other than me writing websites for my courses, some serious use for an AI that either creates new products or saves people money in a business, there are always big articles about it. And they say, well, we saved a lot of people money. But then, on the other hand, there are articles like the Taco Bell story, where they outfitted all their Taco Bells, or a lot of them, and found they didn't work so well. So crypto has not shown the promise that a lot of their folks have said either, but that doesn't keep people from raising a lot of money for these ventures. You look at crypto, they've raised billions this year. There was a couple of IPOs recently on crypto, and if you look at OpenAI, what's the current valuation there? $500 billion, and they're just raised $50 billion. It's questionable whether, frankly, all these enterprises are worth anything like that. I think it's funny how excited people get when there's a new idea out there. I remember in the dot-com bubble in the 98, 99, 2000 period. People get all excited, and rightly so. These are big innovations. The internet was a big thing, and it's changed everybody's life. Artificial intelligence is helpful. I use it every single day. Every single day I use Chat or Claude or Grok for a lot of different things. I'll just give you one example. Teaching fixed income in my class, and I asked ChatGPT to produce the totals for how big is the dollar volume of U.S. Treasuries. Turned out to be $29.6 trillion. How big is the corporate bond market? How big is the municipal bond market? How big is the high yield market? Well, ChatGPT just spins all that right out. And I conveniently put it right into a PowerPoint slide. I get Copilot to help me design it. Away I go. So I use artificial intelligence. I pay $200 a year for Claude, and I pay $200 a year for ChatGPT 5.0. And that's it. I don't really buy any other AI projects. I use the free version of Grok. I don't think they're going to get rich off of me. That's the big issue. Not whether AI is an exciting thing and a good tool. It is. It's all those things. But it makes errors, and it's good for some environments and not good for others. And somebody's got to find a way to monetize it. And sometimes great ideas still have difficult time being monetized. Second is the competitive element. It looks like the U.S. doesn't dominate the AI business. I think OpenAI was really excited, as were its backers, when it first came out with ChatGPT, but that was like ancient history. Now, all over the globe, people are coming at DeepSeek, for example, coming out of China, claims it did the whole thing for a fraction of what OpenAI spent. And poor old Sam Altman, I feel sorry for Sam. Sam's concerned that he works for a nonprofit. And guess what happens if you work for a nonprofit? You might not make as much money as if you turn the company into a for-profit. So Sam's decided to try to turn it into a for-profit. That's what got him ousted as chairman of OpenAI, but he got brought back. But at the end of the day, he'd like to be like Elon and some of his pals, but the road to hundreds of billions of dollars is probably not through a nonprofit company, so he's maneuvering to do something different. But the question is, what do you do different? There are growing signs in almost every direction that the idea that you can make a lot of money developing AI projects, well, maybe if you're an expert in a particular industry, you can use AI to find something new. But I think what the best model for all this is, and I go back to this, is Uber. Uber was created by a gentleman who used known technology. His strength was not technology. His strength was figuring out how to use the technology to create something new and useful to consumers. That's the challenge for people that are knowledgeable about AI. Create something that's useful and helpful to consumers. I have to say they've helped me. I use AI every single day, but if what I'm paying them is what everybody else is going to pay them, it isn't going to be worth the effort on their part. And if, for example, ChatGPT decided to raise their price from $200 a year to $400 a year, I'd probably let it go. Claude's pretty good, and there are others out there that are free. Grok, for example, which does a lot of things for the kind of questions I'm asking it. And so I think the valuations don't make a lot of sense in the artificial intelligence world. And so the capital spending that's going on in that world and in crypto could get in trouble. And if that happened, you've already got consumption spending trending down. If capital spending begins to trend down, and I think clearly it will, then the economy will weaken and we'll fall into recession. I suspect we have already started that process. I think we've got more difficult times ahead. I see a recession coming. I'm beginning to see, for a long time, nobody else was saying anything like this, but I am beginning to hear other voices now. If they're not saying this, they're saying things close to this, that the economy, they're saying maybe the economy could weaken, blah, 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 blah. There's an interesting article about what Warren Buffett's been up to, and what he's been doing is amassing cash. He's not buying anything these days. That also is a small clue out there that while the world is great and wonderful at the moment in the AI land and in crypto land, that there could be chinks in the armor. Eventually, crypto and AI will find a place in the world. I'm not saying they're going to go away, but they're going to ultimately settle down into much lower valuations than what we're looking at right now.
What do you think about Buffett's idea? He has stated that we can solve the U.S. deficit and debt in 5 minutes by requiring all Congress cannot stand for re-election unless the annual deficit is 3% or less of GDP. What do you think, Professor?
Well, I wish Buffett had said that 30 years ago when he was partying with people who created this deficit. Some of his best friends were the biggest proponents of all the massive spending that we now face. So he's a little late to the party. There were many other people hitting that gong a long time ago, the Peterson Institute, for example, among others, that had sounded the alarm about the size of the U.S. national debt and its growth. But honestly, once we put all the healthcare spending things in place, Obamacare, Medicare, and Medicaid, the die was cast. Even if we don't spend anything else, but those three will eventually have a major problem, particularly compounded by the demographics and by the way we spend healthcare money. So I think Buffett's just a little late to the party. I wish he'd been a little earlier. You know, it's interesting. You read his annual reports and they really make great sense. But then you watch who he parties with, and you got to wonder whether he believes his own annual reports. Now, Charlie Munger was a little different, but Buffett himself, you got to wonder.
Professor, you have a big exam Wednesday when the Federal Reserve meets. We're going to see what they're going to do. The federal funds target rate, you stated a reduction of 25 basis points. Time will tell. Professor, thank you.
Thank you, Hunter.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.